Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking about the U.S. office market. My guest is Walter Page. He's Director of Research with the CoStar Group. And Walter, we're talking about the performance of the office market. It's been great. We're seeing great absorption, rent rate growth, occupancy growth. So what's that doing to the office investment market? What are you guys seeing for volume of sales?
How about a 20% increase in sales over last year? And we're basically at the highest level ever recorded outside of 2007 when equity office last traded.
Wow.
So we're at $92 billion of sales so far in the first 3 quarters of the year. The highest it's ever been in the first 3 quarters of the year was $117 billion, and that included nearly $60 billion accounted for by equity office. So the reality is the sales volume today, with absent a single massive transaction, is exceptionally high.
That is remarkable, and that's what we sense as we're selling office properties. There's a lot of demand, and there should be, I guess, with the outlook and the way it's been performing, right?
Yeah. I mean, capital markets like us, it stands up very well relative to the stock market and actually the bond market.
Mm-hmm. So what's that doing to cap rates for some various classes of properties?
So what we've seen is that the cap rates for the best properties have compressed, but not nearly as much as the Class C type properties, actually. Mm-hmm. So what we're starting to see is that investors are fanning out, they're willing to take more risk. And so the cap rates for the best office buildings in most markets is about 5%. The cap rates for Class C segment has actually fallen by 70 basis points over the past year to 7.1%. Mm-hmm. So we're seeing some compression in the cap rates by class. Mm-hmm. As people fan out to find other investments. I think it's also indication of investors, value-add investors, opportunistic investors having plenty of capital.
Yeah, and I guess if the nicest properties cap rates are getting to compress, they're having to look for yield somewhere, right?
Yes.
So what else is in these numbers, Walter, that kind of jump out to you? I mean, it's pretty amazing, all this demand. Is this a lot of foreign capital? Is this because interest rates are so low? What should we make of this?
So there's a lot of things that jump out at me about the data. There is a lot of foreign capital. Some of this foreign capital isn't necessarily as foreign as what you would think, but I mean, for example, you have in Atlanta, you have the Monarch Center, New York Common, and Abu Dhabi sold that to Highwood Properties. So that's a case where foreign investors sold something. On the other hand, in Seattle, we had Beacon Properties sell the Columbia Center to GAW Capital Partners, which is actually a German investment arm. So we do see some international investment activity going on in the marketplace, and we also see increased willingness to take on risk. And I guess that would be the other thing that we're seeing.
Okay. Well, that's interesting. And from what you're saying, maybe a lot of people are perceiving that risk to be very low. So what do you expect for cap rates moving forward?
So obviously we have this expectation that interest rates will eventually rise by the Federal Reserve. We think the market is anticipating this to some degree. So our assumption is that over the next few years, we're going to get in the neighborhood of 10 to 20 basis point increase in cap rates, while interest rates are expected, from the forward futures curve, increasing in the neighborhood of 70 basis points. So we think that the markets are anticipating that.
So then are we at the top of the market then for a lot of these assets right now?
In terms of cap rates, Yes. In terms of pricing, no.
Okay.
And the reason why I'm saying that is that within the office sector, there's a lot of embedded rent growth. That is the difference in the today's rent versus the market rent. So, for example, in the typical office asset, it would be about a 10% differential. So let's say you're paying $20 rent, the market might be 22. In San Francisco, that difference is 33%. And so, assuming that we have relatively stable cap rates that rise just a little bit, the NOI growth and the growth in rents that we anticipate will vastly outpace, or have the value pace vastly outpace the change in the cap rate picture.
That's a very good distinction, too, because I think some people taking just a cursory look would say, well, interest rates are going to impact cap rates. But like you say, if we're going to have NOI growth and we're having the rents rise this much, that's a very good point. And I guess that's why we're seeing a lot of volume in this sales market.
Yes.
Yeah, interesting. So what are some market areas, some cities that you think might be good bets to invest in?
So generally, there's a couple themes I like. One is we like markets that have good drivers of growth and have limited construction.
Well, there's no good drivers in Atlanta. They're all terrible drivers.
Well, Atlanta is actually one of those markets.
All right.
The East Bay, Orange County, Atlanta all stack up very well because the level of construction today relative to normal levels is actually pretty low. The demand numbers are fairly strong, and we think that those markets have opportunity, principally because the rents aren't high enough to support construction on a wide-scale basis. So we would expect there will be some rent pops that will cause value pops, making those good opportunities. Some other markets, the Florida markets, show up really well. Phoenix shows up reasonably well. Denver shows up reasonably well. So we have a number of markets that offer great opportunity.
And are there some markets where you're seeing demand for space decline or absorption issues that investor may want to stay away from?
Well, Houston is the market that I think investors are shying away from. Although the numbers haven't declined nearly as much as I thought they would decline. Principally, we see weakness in the oil market combined with, which will limit demand, and then really high supply levels. There's 12 million square feet underway in Houston. This will cause office vacancies in Houston to rise over a 2-year period of over 4%. We expect that Houston rents will decline in the neighborhood of 5 to 7% during that time period too. So I would be a little hesitant on going into Houston until things settle out a little bit more in the oil markets and the construction pipelines more fully deliver.
All right. Well, that's a good tip, and certainly some great news that you shared with us, Walter, on the office market around the U.S. Thanks for joining us today.
Thank you.
And if you'd like to get more information from the CoStar Group, visit CoStar.com. They cover the entire country, all segments, great information. Well, stay tuned. We'll have more on the U.S. office market. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. RealNex, software for productivity. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit CREshow.com.